We're thrilled to have you today for what promises to be an informative and engaging session. Our featured speaker today is John Koskinen, the Chief Economist at the Wisconsin Department of Revenue. John brings a wealth of knowledge and experience in analyzing economic trends across the state, and today he'll be sharing his insights on the current state of Wisconsin's manufacturing sector and the broader economic landscape. Please join me in welcoming John Koskinen.
Bottom line up front is U.S. manufacturing has entered a soft landing phase. We actually had a very strong start to 2025 with some pockets of weakness. But of course, international trade has created a major certainty, and the federal budget deficit will be a continuing issue. For Wisconsin, we substantially improved our competitiveness and we're in a solid position to outperform the U.S. We have structural advantages in labor force participation, tax burden, and I would also add that pending whatever you're going to see on federal budget reductions, we are probably in a much stronger position than the rest of the country to withstand them. We have a smaller exposure, which is not to say that it won't have impact. It's just to say other states will see a stronger impact than we will. If there is a story to the U.S. economy right now, it's confronting the twin deficit problem, both the budget deficit and the trade deficit, and we'll show implications of both. And of course, following the nature of the discussion, we'll have to start here. International trade. There has been a substantial deterioration in the U.S. trade balance. It's over $1 billion lower than it was 4 years ago. Sorry, wrong number, $1 trillion lower. I highlight on the right-hand side a observation from Klaus Knott, the outgoing chair of the International Monetary Fund Financial Stability Board, also echoed in that same article by a former member of the Bank of England, both of which recognize that this kind of deficit is not structurally sound. And they have highlighted that whatever you think about, shall we say, the current U.S. administration, they recognize the U.S. is now dead serious about the global imbalance issue. And they recognize that you cannot sustain both one of that size, much less the trajectory that you've seen in the current accounts deficit for goods and services. They highlight there is some upper limit beyond which the balance has become counterproductive. It's not just trade. Also, for the United States, we've had a significant decline in foreign direct investment since 2021, compared to where we left off in 2018. That's a key to a point that I'll get to later on. The larger point, seeing how massive the trade deficit has become, the loss of over $1 trillion over the course of the last 4 years. Roughly even those in the European Union are recognizing that's not sustainable for the U.S. or anyone else. There we go. And not just trade, but foreign investment in the United States has also dropped. And there we go. Now, role in GDP. If you have a trade deficit, that actually reduces GDP. In this case, for 2024 on average, our trade deficit had the impact of reducing GDP by $1 trillion. There is, despite sort of all the noise, and it's considerable, there is, if you get past the noise and go to the signal of what's going on, there is a purpose of trade policy, and that is substantially to reprioritize U.S. manufacturing, either once by supporting domestic manufacturing, two, in particular, building defense production, and three, to diminish our vulnerability to global disruption, which we'll get to in a little more discussion shortly. The objective out of that purpose is really just to invest in U.S. manufacturing by leveling the playing field with reciprocal tariffs, reshoring manufacturing, and what I call inshore manufacturing, or boosting foreign direct investment. And then, of course, rather than locate elsewhere, encourage manufacturers to stay home. If there is a sketch of what it's supposed to look like, it's to make that rapidly declining chart start reversing direction, even if you don't eliminate it. The two April 2nd trade orders basically targeted 180 countries, 14,000 commodities, for which targeted effectively 95 countries substantially in deficit. On the exemptions, basically anything that was critical to the United States was exempt outright. There were constant updates to it whenever including computers and smartphones, for example. Often overlooked in the discussions with Canada and Mexico, you had a complete exemption if it was covered in the United States, Mexico, Canada trade agreement. You can see the illustration of where we have our biggest trade deficits. It's predominantly China, Mexico, Vietnam, Germany. At this stage, let's see, they targeted the tariff increases. Basically, reciprocal tariffs are across the board for 10%, but higher ones for which we had the higher trade deficits. Of course, all of that would be pulled, relative to US and Canada. We've had substantial trade deficits with both, particularly increasing trade deficits with Canada, largely because you have, shall we say, intermediate goods transmitted from China to Mexico with the intent of exempting it from tariffs. That is under discussion to prevent that kind of movement. Massive trade deficits with China and Vietnam. Now, in some respects, we have to understand in the geopolitical context, everything is about China. Secretary Bessent, even on Face the Nation on January 1st, highlighted that China was an unreliable trade partner during the COVID eras, and whatever else you're dealing with, and you can see it now even in the discussion of the rare earths holding back, that if China is an unreliable trade partner, it's a recognition that worldwide, and it's not just the US, that everyone has to develop alternative supply channels to China. It is also not just a tariff issue at this point. It is, if you're dealing with China, you run the risk of forced technology transfer. In other words, if you want to build there, you've got to transfer the technology to go with it. You have to cope with industries that are receiving state subsidies. China's known for currency manipulation. And if you're building there, you are compelled to buy from state-owned enterprises. And on the right-hand side, you run the risk of counterfeit goods. You cannot enforce copyrights or patents. And they basically have authorized new measures to prevent anybody from trying to enforce their intellectual property. It's also not just trade manipulation, it's also security interests. China has been in an adversarial position for the United States subtly for the last few years. All of those things suggest that from a strategic standpoint, the US is trying to get less exposure to China, not only on trade, but also for strategic interests. Now, fluid situation. When first announced, out of the $5.3 trillion worth of trade volumes, that's both exports and imports, basically countries that already accepted a negotiating position covered about 2.3 trillion, 2.3 trillion. Canada and Mexico, in terms of the USMCA, are the dominant. That's over a third of US trade by itself, was completely not covered. The only retaliating nations were originally Canada for the non-USMCA borders, China, European Union, but lo and behold, let's roll the calendar forward. And at this stage, every country in the world is in the process of negotiating with the United States on resettling trade. So for all the chaos, this is basically a design to try and reset the international trade order, and with all that applies. For us, a quick view of our international trade, we've had a substantial increase in our exports, but we've had a substantial deterioration in balance of trade. In other words, a lot more trade is going on, but we're on the short end of it. Where our principal trade balances are, of course, massive trade deficit with Canada, and then surprisingly, Ireland, followed by Vietnam, Mexico, Germany, with the exception of Ireland, that's consistent with all of the US. We have trade surplus with Canada, Australia, etc. Our top 10 exports are basically the center of our industry, both ag machinery, computer equipment, navigational equipment, general purpose machinery, plastics, electrical equipment, engines and power transmission, motor vehicles and parts, pharmaceuticals. Principal export is pharmaceuticals, and we'll hold that space because that has significance later on. Then it's general purpose machinery, other instrumentation, apparel. We have a massive trade deficit because we don't have an industry in that presence, but we do have, of course, retailers that rely on imports from Vietnam, China, Sri Lanka. Think of terms of all our major retailers or online sellers that do that kind of an import. When I started looking at the data, I started realizing I'm used to thinking, of course, of fabricated metals and machinery, possibly foundry products as well as being principal exports. That's true. But some of our surges in trade over the last few years, when you saw that trade surge for us in the total, we have to reimagine Wisconsin manufacturing and get out of the mindset of the Rust Belt. Hence my joke that perhaps if we think in terms of where we're getting our growth in exports, maybe it's rocket science. We're seeing a tremendous surge in computer equipment and a tremendous surge in aerospace equipment, whereas once upon a time, dairy products had better exports than aerospace equipment. Now it's dwarfed. Electrical equipment is something we've been good at for a long time, but now computer equipment exceeds it. Our largest trade surplus is with Canada. Basically, so relative to the trade relationship with Canada, we're probably more exposed than most other people, but we have a trade surplus with them. All of those products listed are on the side for your, and I won't read through them, but principally, we know what they are. It's agricultural construction machinery, converted paper products, plastics, electrical equipment. But our second largest trade deficit is Ireland, which was sort of startling. And if you look at where we export to Ireland, you'll notice, for example, dairy products is not on the list, but we import substantial dairy products for them, and I haven't figured out whether or not we actually require that much Irish butter compared to what it was. Relative to dairy products, to me, it's startling to see how substantial a trade deficit we have in dairy products with the European Union. Most of, and it's substantial, the European Union is probably, for all intent and purpose, closed to us for dairy products. In terms of why we have a trade deficit with Ireland, it is predominantly that first line with its pharmaceuticals and medicines. About $3.3 billion worth is imported into the state of Wisconsin, arguably just for redistribution elsewhere in the country. And again, we'll come back to this. One of the things that has been happening is you've had, for U.S. manufacturing, a substantial change in manufacturing investment, most of which is going in traditional manufacturing centers, including ourselves. If we think in terms of one of the objectives would be, as I characterize it, not only to reinvest in the United States, but to reshore and get foreign direct investment. There has been a substantial increase in investment in the state of Wisconsin in terms of a pipeline. I highlighted the pharmaceuticals, and under the blue where you see reshoring, Eli Lilly will be investing $3 billion in the state of Wisconsin to build out pharmaceutical manufacturing, and they highlight in their press release that it's part of their global overall strategy. So in terms of not only will we continue to probably import pharmaceuticals with the intent of distributing the rest of the country, we're actually going to continue to produce more. A very subtle change in Wisconsin manufacturing is the development of the pharmaceuticals industry here in the state of Wisconsin, whether it's diagnostics, for example, Exact Sciences, or now the acquisition and expansion of pharmaceuticals in the case of Eli Lilly. In the yellow is, I highlighted the decline in foreign direct investment in the U.S. from 2021. We're seeing a turnaround for that for ourselves. Everything in yellow are actually foreign-owned companies that have targeted either acquisition or expansion for investments in the state of Wisconsin. And then, of course, in the green, it's also what I call the stay home, that we are expanding in chemicals, food, petroleum products, or the equivalent, and primary metals. All right, federal budget. Federal budget, if you think in terms of what you need to reduce the budget to a balance, there's a $2 trillion mismatch. If you even got any kind of reductions in the tune of 700 billion, you'd be roughly in the position you were before the pandemic hit. The challenge is, as the federal government continues to basically outspend its receipts, it has to borrow the money to make up the difference. While the total indebtedness of the United States, all sectors, business, consumer, government, is actually not growing substantially faster than real GDP. The challenge is the federal government is soaking up basically all of the increase. Consumers have been actually decreasing their indebtedness as a share of GDP. Businesses are basically doing the same thing. In contrast, the federal government has increased it substantially. That has the property of putting pressure on borrowing costs. If there is a focal point for the administration, and I would say it's an easy way to track what's going on. The headlines are, shall we say, very busy and probably not as informative. If there is a focal point for the U.S. economy to get stronger, it's what happens to long-term rates. And the administration has signaled they're focusing on the 10-year Treasury rate. Why? Because that becomes a benchmark security for long-term lending, whether it's mortgages or corporate bonds. It reflects all economy-wide forces. It's not subject to manipulation by the Federal Reserve. It is the market deciding what the interest rates are. If you can get lower federal interest rates, it's more stimulative than a federal funds rate because mortgage rates drop, corporate bonds drop, and the federal government's interest costs will also go down. At this stage, the federal government spends more money on interest than we do on debt. Defense. We are at this stage 230 basis points then higher in terms of interest costs than we were left off in 2019. And you can see the red line being the Treasury rate. You can see exactly the corporate bond rates will follow the movement of the federal debt rates. It's particularly true with mortgage-backed securities, which actually explicitly benchmark to the 10-year Treasury rate. For manufacturers, that does have a cost. The higher interest rates have driven up costs for manufacturers. Manufacturers at this point, in terms of interest payments as a percentage of net sales, set aside the anomaly for the quarter of the COVID contraction. Manufacturers at this stage are spending more money on interest relative to sales than they did during the worst of the financial panic that was the Great Recession. Now, you can track this on your own if you like. My advice to many people is if you pull out your smartphone and you have the stocks app, if you look for TNX, you can see the year-to-date growth, year-to-date graph. The red is actually what you're looking for is lower interest rates because they take the perspective of you as an investor rather than what's good for overall borrowing costs. Green would signal higher rates. That's bad. We are slightly below where we started the year, but not much. After a big retreat, we've come back up as people have started paying attention to the pressure that federal borrowing puts on interest rates. In terms of overall strategy, the prospects of further federal deficits depends on certain sensitivities, not the least of which is if the economy grows stronger, there is less pressure on the deficit. If the economy grows weaker, there's more pressure on the deficit. If interest rates are lower, there's lower pressure on the deficit. Wisconsin's in a relatively good position relative to any prospective reductions in force, that we have the lowest share of federal employment among state economies. Needless to say, those states in red, particularly notice that area right around Washington, D.C., are most sensitive to any reductions in federal employment. There's also, in terms of impacts on research grants, that tends to be concentrated in the Northeast and California. We are more modestly affected. Similarly for National Science Foundation grants, the same thing. Basically, Massachusetts is probably most exposed to both of those, followed by California. We are less exposed, and even that exposure is concentrated to the University of Wisconsin, and in the case of NIH, Medical College of Wisconsin, and to a lesser extent, Marquette, and UWM. So, and to the extent we have exposure, even there, it's concentrated in the 2nd Congressional District. All right, let's go to U.S. manufacturing and outside of all of that context. U.S. manufacturing actually started off the year very well. We had a very good first 3 months of the year. And at this point, manufacturing industrial production is full up 1.3% compared to where we were in April 2025. You had a long gradual decline during most of April 2024. That's reversed very quickly. And even despite all the adverse news, industrial production is running ahead of last year. There is a disparity. It depends critically on your industry. In general, though, durable goods are up in the aggregate, with basically some declines in fabricated metals, which affect us, and wood products, which affect us. But furniture miscellaneous down on the non-durable side, that's up in a very big way, with the surge being in the chemical industry. The chemical industry is where you find pharmaceuticals. If we're rebuilding pharmaceutical industry in the United States, that type of expansion is going to continue. Total manufacturing orders was sliding through most of 2024. Year to date, we're up 2% April 2025 compared to April 2024. Durable goods orders are up 4.2%, and manufacturing payrolls sort of had at the beginning of the year, in particular, the first 3 months, we had 3 consecutive months where we were adding manufacturing employment back to back to back. April was a slight offset as sort of uncertainty hit the market, but you can see the reversal, or what I would characterize as stabilization, where we were having gradual continual decline since basically late 2022 through late 2024. That's reversed and it's stabilized or improving. I even have to go back. This is actually the ADP private employment report for manufacturing. I have not illustrated because I didn't have the time to pull it off, but was fascinating. The business press reacted badly to the ADP private employment report only growing about 33,000. What was fascinating to me, they don't give you the regional breakout. The big losses are all East Coast and West Coast. The Midwest had basically the largest regional gain in employment. Of that 33,000, 21,000 was just in the Midwest. So relative to our competitive position, as we're seeing all of that, we're actually seeing the Midwest being in a stable position. Manufacturing sales and net income. Whoops, got to go back one. There we go. Fourth quarter, 24 over 23, we're seeing both sales and income improving. New orders for durable goods, excluding transportation, are rising. And in transportation, it tends to be highly sensitive to what's going on in motor vehicles and, of course, aerospace industries. But in all other cases, you saw a very good set of new orders coming through. Non-durable goods shipments, modest growth with the exception of a few industries, but again, chemicals is sort of leading the way. It is, even if you have seen growth in a particular industry. When you get into the subsector, it's not quite the same. While we're getting gains, for example, in primary metals, iron and steel at the time was declining, even if we were getting expansion everywhere else. Machinery depends critically on which ones. I'm sorry, my screen is not cooperating with me, and I'm even having a hard time seeing it. I assume you see it decently. Somebody's going to have to give me correctly because I'm getting a lot of gray right now.
Yeah, we can see it fine on our side.
Okay, I have to see what I did. Oh, well, I'll just proceed. Keep going. Similarly, subsectors, different subsectors, computers, electronics, it's big on basically servers and computers, not so much medical diagnostics. Transportation orders are down but the big decline is, of course, all in aircraft. Manufacturing workforce at this point, job openings and hirings have returned basically back to pre-pandemic levels, consistent with what we were seeing some of the employment stuff before. The overall pattern is almost evolved to a stable situation. We're actually seeing new hiring after coming up slightly after falling well below pre-pandemic levels. For Wisconsin manufacturing, of course, fundamental, we're 8th among states for manufacturing employment. In terms of manufacturing intensity, we're in the number 2 state. Those are the leading industries. So you can see that later. Some of our traditional ones. In terms of employment, we are reflecting the national picture. Durable goods employment declined, but that decline has now sort of starting to reverse itself. Non-durable goods employment, we had coming off a decline. We're actually now seeing year-over-year increases again. All right, tax competitiveness. Overall, we are in the best tax position we've been in over 40 years. At this point, we are 35th in the nation. And in terms of if it was a tax decision, we're in a situation we've significantly reduced our individual income tax burden to the point where we were below the U.S. average. Our property tax burden overall, and that's all industries, is not necessarily homeowners. And even then, if I get into longer discussions, it depends on which market you're speaking of, but we significantly reduced our property tax burden as well. Our overall business tax employment is now highly competitive. We are actually in the lower quartile, at least as judged by Ernst & Young. But even the Tax Foundation has recognized the substantial competitive position we've been in as a result of having the exemption of business personal property tax exemption, which went into effect January 2024 and impacted the tax bills in 2025. Labor force. We are more engaged in the labor force, no matter how you get around it. It's true for men, women, and ethnicity. In particular, we are more engaged by every age group, with the exception of over 65. My lecture these days is to concentrate on the youth and the youth in that territory. Notice the gap for teenagers in the 2024 and how it continues all the way through. For prime working age population by itself, we have the 7th highest labor force participation. More than 5 out of 6 are actually working in the labor force in the state of Wisconsin. Big contrast to what you see in Florida or California or New York even. Among the youth labor force participation, that's 16 to 24, we have the 2nd highest labor force participation rate with over 70%. There is a cultural of work that is actually suggest what helps to lift our overall labor force participation is what we see in the young. If we expand the definition of prime working age population from 25 to 54 to 20 to 54, we have the 4th highest labor force participation rate in the country. In the little note down below on the lower left, if the United States had the same labor force participation rate, start again. If Wisconsin had the same labor force participation rate as the U.S., our labor force would be 225,000 smaller. Because of a cultural work that we have here, we have better availability of labor simply because we're more likely to be working. This is now my new poster child. As I started seeing some of the discussion on whether or not you could reshore manufacturing in the United States, I saw multiple commentators say the workers aren't there because young men are no longer interested in working. Written by columnists, for example, from the Wall Street Journal. A critical, and I would call our secret weapon, is that young men in the state of Wisconsin do work. Our labor force participation, we have over 93% of men 25 to 34. They're not in their parents' basement. They are actually in the labor force working or looking for work. Contrast that, for example, to California or New York. We are among the sweet spot of making sure that our men are engaged in the labor force, and that's an advantage that is, to me, very subtle, but also very powerful if we think in terms of if we have to rebuild a manufacturing workforce, we start with the advantage of young men are actually anxious to be working. Educational attainment, we outperform the US for workforce readiness, no matter how you slice it. In particular, we have lower unemployment rate by any educational attainment as well, way ahead of the US. Current labor markets, overall Wisconsin employment is up 15,000 compared to the same time last year. We rank 9th in the overall employment to population ratio. By our established household survey, which is basically asking people whether they live or work, where unemployment rate is ticked up a bit to 3.3%. It's still at full employment levels. What's fascinating to see is the revision, which is the red line, of we actually have more people working than we originally thought. So even if you see a small decline now, we're still running way ahead of last year, at least where we thought we were. Job openings at this point are basically almost at pre-pandemic levels again, slightly below, but overall job openings have been stable since July 2024. Our labor shortage is again back to pre-pandemic levels, so we're not out of the woods in terms of labor shortage because that was a condition for us in 2019. That condition continues. Over the long view, job openings, while they retreated from post-pandemic highs, they've retreated. We were basically, compared to where we were at the beginning of the century, we're still running substantially higher for job openings. That will have an implication later when I get to it. Hiring overall is again back to pre-pandemic levels, so we're hitting sort of a stable situation. Our layoffs remain near record lows. All of this segues nicely into this one, population and net migration. In 2024, we were ranked 15th in states for domestic net migration. Significantly, we switched to a net in-migration after 2015. And if we push it a little further, how do we get the net in-migration? I characterize the field of dreams. If the job opportunities are there, if you build it, they will come. If the job opportunities are here, two nice things happen. When job opportunities are scarce, residents leave, non-residents don't come in. When job opportunities are plentiful, those that live here are encouraged to stay. Non-residents are encouraged to move in. We have this lovely break-even point. So long as our unemployment rate is below 4%, we attract net in-migration. All right, topic that everybody likes talking about, but it is recession risk. The yield curve suggests our outlook is stable, and I think that would be the best word to describe it. For all the noise, when you consider everything in its totality, we're roughly in a stable situation with a growth rate of about 1.7%. Whether or not the overall risk of recession has actually retreated compared to where we were a year ago, we're down to about 27%. A year ago at this time, the risk was 50-50. And the risk has actually retreated after some of the original panic coming out of the initial announcement of the tariffs. Overall outlook for the U.S. from the Federal Reserve is about 1.7% for this year and next year. That is highly consistent with most private forecasters at this stage. I would also say it's very consistent with the most recent release from the Institute for Supply Management's reading of the economy for manufacturers. They said the manufacturing reading, while it was down slightly, is consistent with a 1.7% growth. Basically, the good news out of this, if we were to pay close attention to it, their estimate of the inflation rate, we are now tending below that. The other of which is, as you think in terms of prospective rate reductions, the Federal Reserve signaled back in March that they are anticipating getting the federal funds rate lowered from its current about 4.3, 4.5 to about 3.9 by the end of the year. Inflation has dropped at this stage to a 4-year low. Federal funds rate is now well above the inflation rate, suggesting the Federal Reserve does have room to reduce the federal funds rate shortly without necessarily putting yourself in an inflationary position again. That would be consistent with what they see their glide path to be, that they're expecting core inflation to drop to a nice level, and then they can gradually start reducing the federal funds rate over the next few years. For us on our Wisconsin outlook, we're expecting much consistent with the U.S. that we would sort of follow that pattern. We're expecting steady growth in the 1.7% territory. in 25, 26, and 27. Our unemployment rate will drift slightly higher, but still below the near our record lows, and will be below 4% throughout the forecast horizon. We're expecting gradual increase in employment from the establishment story, consistent with what we're seeing from most recent data, expanding throughout the year. Personal income, we saw a drop in wages and salaries growth rate, not a drop in the overall level. The level will continue to increase, but at a slower rate because inflation is coming down. And that is the end of the slides. And at that point, I would be open to questions.
John, I didn't see anything in here on volatility.
Ah,
What are you seeing around how these things will be bouncing as opposed to just a single number over these years?
I was that's an excellent question. And this is the kind of question I love because you're going to make me think about it, and I'm going to have to develop a slide with it. Unfortunately, you won't see it, but the next group will. I'm actually expecting right now, I expect sort of people have sort of moved back while they wait for things to settle out and you get the trade policy announcements. I think there's a deadline. I originally gave it June 30th, but I'm thinking it might be the end of July. So after you sort of going sideways for a little bit, I think you see the takeoff again, sort of third quarter, fourth quarter. In terms of volatility, the markets react to headline news, which I think is terribly misleading. And I think the behavior doesn't follow it. So some of the volatility, particularly in the markets, well, I could go on an editorial opinion on the wisdom of that, but some of the volatility I've seen, I was very encouraged to see the personal income report. We are seeing reasonably good orders. I mean, some of it surged. Unless the orders start falling, which they haven't, they basically pop you. So you can get a situation to your volatility point. New orders for manufacturing surged in March. They were ridiculously high. Then they come back down to what would be a sustainable level. And of course, the business press will say new orders fell by such and such because they compared 1 month to the next. You'll see subtly, I avoid doing that by looking at year-to-date numbers or even year-over-year numbers. So that washes out the volatility. You will get volatility because people react to it adversely. I think you will see a favorable bounce at such point as the Federal Reserve reduces interest rates. The next meeting is next week, right? I think that's right. Might even be this. I have to double check. It might be this week. I think, unfortunately, shall we say, chief executives' tendency to message at 2 a.m. Sometimes I described it as if Donald Trump was the brand manager for trade relations with Canada, and I was doing his performance review, I would say needs improvement. Sometimes the relationship with him and Jerome Powell, for example, I think the Federal Reserve was all set to do a rate reduction, especially seeing the news. I'm not sure they want to react by being heavily lobbied. Because I think they want to assert their independence, which I think has an adverse impact, but I think that lasts a grand total of 30 days. So relative to volatility is inherently short term. I think the fundamentals are stronger. And at such point as you get the trade relationship settled out, a lot of the uncertainty of tariffs moves out of the way, and then people can go back to the considerable momentum that was actually underway in the economy before all of this hit. I don't think we're going to. So I'm a long run optimistic, not even long run, optimistic starting third quarter. How's that? Long answer. I hope it was on point.
Was.
Jason Eccles put in the chat, he said, do you foresee incentives becoming available for Wisconsin manufacturers to invest in Wisconsin to support reshoring?
I'm sorry, give me the question again.
Do you foresee incentives becoming available for Wisconsin manufacturers to reshore?
I would argue I would need more precision. I think there are incentives in place, not the least of which is as You can see it. I mean, we've been having the foreign direct investment. In terms of the other reshoring, you'll see more of it. Structurally, we have a series of plays through tax incentives, not the least of which is you have to avoid. I did not get into tax policy relative to the Build Back Better bill, lots of which some of the immediate expensing of some of the equipment that is in the tax code that is part of that bill. Part of the reason you worry about the deficit is, of course, you had the tax reductions relative to tax increases that would have taken place that are now forestalled and keep current incentives to build and manufacturing in place. The only case where I see certain incentives being pulled back would be in the green energy space. But if you're not there, if you're in the traditional manufacturing, I think they are in place. So I would need more precision on the question, so I'm speaking just in generalities.
And there was another question here. As an economic attractor, how is Wisconsin's electrical cost competitiveness? And then they also asked, would you know the estimated impact of the nuclear facility in Kewaunee restarting?
The overall, we are very competitive. We are highly competitive internationally on manufacturing electricity rates. We are actually at the stage where, relatively speaking, our ranking has dropped. We're just above the median rate right now for industrial electricity. In terms of should Kewaunee be restarted, one of the things in I actually pulled it out of here. I actually had it in. The demand on electricity because of the investment in data centers and everything else, we have to be seriously expanding our electric capacity. So if we were to bring Kewaunee back online, that would give us improved reliability. That tends to be the issue, and the challenge is just the overall supply. You did see, for example, PSC just green light new gas turbines in Kenosha just to support a data center. So I hope that's sufficient, but it's the number one thing is, at last I looked, and I'll have to double check it, is that you need to get Point Beach. They had applied for a 20-year extension back in 2020. That was delayed, and that is still set for decommissioning, I want to say in 2030 and 2033. I don't know whether or not they've received final approval. I will have to go back and check that. So in terms of providing sort of large-scale baseload energy, especially large-scale baseload energy, zero carbon emissions, restarting Kewaunee would move us to a long way for all of that. Not the least of which is the grid is there. Relative to restarting, I think they were pulling out the lines. I'd have to go back and check to see what the current status is.